Welcome to the Deep Dive. I'm your host, and today we are getting into something that is, frankly, about to shake up the entire financial world.
Yeah, glad to be here. This is it's a massive topic.
It really is. Okay, let's unpack this.
hmm
I want you to imagine Wall Street for a second, right?
Mm.
But picture it as a highly exclusive, world-renowned restaurant.
Okay, I like that.
So it's the kind of place where, the tables are always full, reservations are booked months in advance, the maitre d' runs a very tight ship.
Right, extremely exclusive.
Exactly. Now, imagine that right in the middle of the dinner rush, three massive double-decker tour buses just pull up to the front door at the exact same time.
Just absolute chaos.
Total chaos.
hmm
Hundreds of VIPs pour out, and they are demanding to be seated immediately. So the problem for this restaurant isn't just figuring out what's on the menu for all these new people.
No, it's where do you even put them?
Right. The real crisis is trying to figure out if they actually have enough tables, chairs, floor space to seat them all without, kicking their best, most loyal customers out onto the street.
And that analogy is spot on because we are looking at a scenario that is going to test the structural capacity of global markets. I mean, in a way that goes far beyond just standard market volatility.
Because those three tour buses, they represent three of the most highly anticipated IPOs in the history of the stock market.
Exactly. We're talking about OpenAI, SpaceX, and Anthropic.
And our goal for this deep dive today is to really look past the cultural hype, right? We want to understand the actual market physics at play here.
Yeah, because we need to dissect why this specific combination of mega IPOs all hitting at once is just, well, it's an unprecedented stress test for the financial ecosystem.
And to do that, we are pulling from a massive stack of source material. We've got the confidential IPO filings that literally just dropped.
Hot off the presses.
Right. We've got deep dive market intelligence data from PitchBook, plus some really recent Bloomberg interviews with tech CEOs who are, frankly, actively shipping their strategies because of this.
The news cycle is moving incredibly fast here.
Oh, it's lightning speed. I mean, just this past Monday, OpenAI confidentially filed its IPO paperwork. And that joins its chief rival, Anthropic, who filed just last week.
And then you have SpaceX, which has been gearing up for this debut for a while now.
Right. So we're looking at a tectonic shift at the intersection of finance and tech. Let's just look at the sheer scale of the capital involved first.
Yeah, let's look at the numbers.
Because all three of these companies, OpenAI, SpaceX, Anthropic, they're currently valued in the $1 trillion range.
Three $1 trillion behemoths. And they are all aiming to go public within the same general time frame in 2026.
Which is wild.
It is wild. And, they're stepping into a market environment that is already completely saturated with artificial intelligence investment.
Oh, yeah. If you look at the S&P 500 stocks exposed to this AI build-out, they have doubled in value this year alone.
Right, but what's fascinating here is that creates a really tricky dynamic. There's this tendency to look at those doubling valuations and just assume, well, the market is flush with infinite cash.
Right, like money is just growing on trees.
Exactly. But market capitalization is just paper wealth. When an IPO actually happens, these companies are asking for hard, liquid cash.
They want actual dollars.
Yeah. I mean, Silicon Valley is currently planning to spend trillions on data center infrastructure over the coming years, and they are turning to Wall Street to fit that bill.
And the early indicators of that demand are definitely intense. Like, look at the early reports on the SpaceX IPO.
Oh, the oversubscription is crazy.
It's insane. SpaceX plans to sell about $75 billion worth of stock, but the offering is reportedly 2 times oversubscribed.
Meaning there is $150 billion worth of capital actively fighting just to get an allocation.
We saw something similar with Alphabet last week, too. They went to the market to sell $40 billion in shares to fund AI investments.
And the demand was so strong, they ended up selling $45 billion.
Right. The market practically forced them to take more money.
But the danger here, and this is crucial, is that inside a hype cycle, demand for exposure to a new technology sort of overrides traditional market caution.
It creates an illusion, right?
Exactly, an illusion of infinite liquidity. The excitement masks the reality of market physics. There is, at the end of the day, a finite amount of capital available for equity allocation.
Even at the highest institutional levels.
Yes. PitchBook actually estimates that combined, SpaceX, OpenAI, and Anthropic are going to raise at least $180 billion in their IPOs.
Wait, $180 billion?
At least!
Which is an incredible figure. I mean, I was looking at the notes that $180 billion is more money than the combined total raised by all of the more than 400 U.S. companies that went public in the year 2021.
It's staggering.
But this is where I find myself, questioning the mechanics of it all. We see all this cash flying around for Alphabet and SpaceX, but is there a ceiling to this insatiable appetite? Or is Wall Street just a bottomless pit of AI funding right now?
No, the ceiling absolutely exists, and hitting it is precisely what causes structural damage to the broader market. Because when investors commit to buying $180 billion worth of brand new stock from these three companies, that cash doesn't just materialize out of the ether.
It has to come from somewhere.
It has to be drained from existing equity allocations. And this is where the monumental size of these offerings shifts from being, a testament to their success to a severe liability for the broader market.
So what does this all mean in practice?
We are talking about a concept called reallocation pressure.
Okay, let's unpack reallocation pressure. Because to the average retail investor listening, buying a new stock just means transferring some cash from a savings account to a brokerage.
Right, a few clicks on an app.
Exactly. But we aren't talking about retail investors here. We're talking about the massive institutional players who move the actual markets.
We are talking about giant pension funds, sovereign wealth funds, mutual funds, and they operate under these things called large cap growth mandates.
A mandate being the rules they have to follow.
Exactly. A mandate is essentially the strict set of rules a fund manager is legally bound by their prospectus to follow.
Right.
So if they run a large cap growth fund, they are legally required to maintain specific weightings in the largest, fastest growing companies in the market.
Just to ensure they don't underperform their benchmark index.
Right. So when three new trillion-dollar companies suddenly hit the public markets, these fund managers don't really have a choice.
They absolutely must buy into these IPOs to fulfill their mandates.
They have to maintain their tracking against the index.
But because their capital is already fully deployed in the market, buying the new companies means they have to sell something else.
Precisely.
It's like operating a massive cargo ship with a strict weight limit. If you want to load 3 brand new, incredibly heavy shipping containers onto the deck, you literally have to throw some of your existing cargo overboard just to stay afloat.
That is the exact mechanism at play. To afford their mandated allocations in OpenAI, Anthropic, and SpaceX, these institutional funds are forced to systematically liquidate their holdings in the current pillars of their portfolios.
So they're dumping stocks like NVIDIA, Microsoft, Google.
Meta, exactly. And we are seeing this play out in real time right now. Nancy Tengler, the CEO of Laffer Tengler Investments, she actually confirmed her firm is already in the process of selling off some of their high-flying chip stocks.
Wait, specifically to free up capital for these new entrants?
Yes, to get ready for this.
That is wild. It's like selling off your reliable, top-of-the-line luxury car that gets you to work every day just so you can afford the down payment on a shiny experimental rocket ship.
That's a great way to put it. And if we connect this to the bigger picture, if every institutional fund on Wall Street is algorithmically forced to sell their existing tech holdings on the exact same timeline,
The selling pressure is going to be immense.
the sheer volume of that selling pressure is going to drag down the prices of the established market leaders. It creates a structural headwind for the entire market.
So their mere existence is hurting the current giants.
Some analysts are already attributing the tech stock weakness we've seen since late last week directly to this institutional repositioning. The market is preemptively liquidating.
So the success of these 3 in the IPO pipeline is actively suppressing the valuations of the foundational pillars of the stock market.
Yes.
Okay, that capital drain makes sense at the mega cap level.
Yeah.
But what really stood out to me in the Bloomberg interviews we reviewed is how this dynamic is utterly suffocating the smaller private companies.
Oh, the crowding out effect here is severe.
Yeah, because the institutional dry powder is being hoovered up, and it is locking other companies out of the market entirely.
When buy-side institutional budgets are entirely consumed by preparing for a $180 billion impact, there is just zero appetite for anything else. The capital allocation window simply closes for the rest of the ecosystem.
And we see this perfectly illustrated with Databricks. Ali Ghodsi, the CEO of Databricks, he went on Bloomberg television last week and flat out stated that his company will not go public in 2026.
Right, he called it a terrible year to go public.
A, quote, terrible year to go public, directly referencing the impending listings of OpenAI and Anthropic.
And for context here, Databricks is a highly successful company.
Very successful.
Yeah.
They're currently valued at $134 billion.
Exactly.
Yet, because OpenAI and Anthropic are valued at more than 5 times that amount, this $134 billion powerhouse is essentially getting bullied off the IPO playground.
It's incredible.
Does this mean the public equity markets have lost their original function? Like, are they now just an exclusive reserve for trillion-dollar titans?
This raises an important question, frankly. It forces a serious reevaluation of how our financial ecosystem functions.
Because it's supposed to fund broad innovation, right?
Right. The public markets are designed to be a mechanism for raising capital across a broad spectrum of promising businesses, providing liquidity, price discovery.
Right.
But when institutional allocators only have the bandwidth to absorb 3 megacaps, the growth trajectory for every other private company is fundamentally altered.
Because they can't get the funding.
Exactly. If a $100 billion enterprise has to remain private simply because the buy-side budget is exhausted, those companies are forced to rely on private debt or, more restrictive venture funding
Which slows their growth.
and delays their ability to compete globally.
And because the buy-side budget has a hard limit, the actual order in which these 3 megacaps hit the market becomes an incredibly high-stakes game.
Oh, it's a game of musical chairs.
The sequence matters just as much as the company itself.
The sequence dictates the underlying mathematics of the valuations. The first company to successfully list sets the comparable valuation, the comp, for everyone else who follows in that specific sector.
So Wall Street relies heavily on that benchmarking.
Very heavily. They look at the first company's revenue multiples, growth rates, margins, and they use those metrics to build the pricing models for the competitors.
So SpaceX is widely expected to go first in this sequence.
Right.
And looking at the analyst notes, they are expected to anchor some extremely high infrastructure valuations, largely because they are backed by the healthy profit margins of their Starlink business.
Yes, they aren't just selling a vision of future space travel. They have a proven cash-generating machine attached to their rocket business.
But the real friction, the main event in this sequencing drama, is the rivalry between Anthropic and OpenAI.
That rivalry is the most consequential dynamic in this entire scenario. Anthropic filed their confidential paperwork before OpenAI did.
Just last week?
Right. If Anthropic manages to list first, and they report their first profitable quarter during that IPO process, it fundamentally alters the financial modeling that institutions will use to evaluate OpenAI.
Here's where it gets really interesting. Because if Anthropic proves to Wall Street that a cutting-edge AI company can actually generate a profit right now, they set a benchmark that OpenAI currently cannot meet. It's like releasing a massively expensive, hyped-up blockbuster movie on the exact same weekend as the sequel to Avatar.
That is a brilliant comparison.
Right. If the Avatar sequel proves you can deliver groundbreaking visual effects while keeping the production budget tight and highly profitable, the studio that spent twice as much money on their movie with no guaranteed box office return, they're going to get destroyed by the critics.
That is the perfect way to look at the institutional modeling. Because if Anthropic goes public at, say, a 50 times forward earnings multiple because they are profitable, institutional analysts will apply that exact same lens to OpenAI.
And OpenAI is still burning cash.
Massive amounts of cash to sustain its growth. So the traditional financial models break down. The institutions will demand a massive discount on OpenAI's valuation.
Wow.
According to the analysis in our sources, there is no structural scenario where pricing themselves against a profitable Anthropic favors OpenAI.
Which totally explains the rather defensive statement OpenAI released alongside their confidential filing.
Yeah, that statement was very telling.
They noted, quote, "We have not decided on timing yet. It may be a while because there are things we want to do that are likely easier as a private company."
Yeah.
It sounds like they realize that going public based on cultural hype and, ChatGPT brand recognition isn't going to survive the rigorous math-driven scrutiny of a public market that has just been handed a profitable benchmark by their biggest rival.
Public markets are notoriously unforgiving of massive cash burns, far more so than venture capitalists.
Right.
By signaling a potential delay, OpenAI is likely trying to buy time to shore up its unit economics. They need to transition from a growth-at-all-costs model to a structurally sound, profitable enterprise.
Because if they don't,
They know that if they launch into the market and their valuation is rejected by public investors who are comparing them to Anthropic, the consequences extend far beyond their own boardroom.
right. And that brings us to the ultimate stakes of this situation. We've talked about the capital drain, the institutional mandates, the valuation benchmarking.
But the ripple effects are what really matter.
Exactly. The ripple effects of these three IPOs
Yeah.
will dictate the actual real-world technological advancement of artificial intelligence.
The financial maneuvering we are discussing is just the plumbing. The output is the future of the technology itself.
Yeah, Aravind Srinivas, the CEO of Perplexity, he actually highlighted this in a recent CNBC interview.
Right. He pointed out that the success of these mega IPOs is intrinsically linked to frontier model development.
And let's clarify what frontier model development actually requires, because it's not just a software update.
No, not at all.
Building the absolute cutting edge of AI requires tens of thousands of GPUs, massive energy consumption, and continuous multi-billion-dollar capital expenditures.
It's closer to building a nationwide electrical grid than it is to coding an app.
The physical requirements are just astronomical.
Exactly. So if these mega IPOs succeed, they secure the billions necessary to fund that infrastructure, which then pushes the underlying intelligence of AI forward. As those base models get smarter and faster, the downstream applications, the software layers built on top of them, like Perplexity, they also improve.
But the inverse scenario is where the systemic risk lies.
Right.
Because if OpenAI goes to the public market and the demand isn't there, or the institutions demand a severe discount on their valuation, it doesn't just hurt OpenAI's stock price.
No, it instantly reprices the entire private AI market.
Wow.
Think about it. Venture capital valuations are entirely dependent on the expectation of a lucrative public exit.
Right, they need the payoff at the end.
So if the biggest player in the space stumbles at the finish line, venture capitalists will instantly pull term sheets. They'll slash valuations for every AI startup, from the largest unicorns all the way down to the seed level.
So the funding just dries up.
The capital required to run those downstream applications dries up, research slows down, and the entire timeline for AI advancement gets fundamentally rewritten.
So essentially, the entire AI startup ecosystem is holding its collective breath, totally reliant on a trickle-down effect.
Yeah.
They need OpenAI and Anthropic to execute flawless financial acrobatics and basically stick the landing on Wall Street, just to keep the infrastructure roadmap alive and their own private valuations from falling off a cliff.
It really highlights how deeply interconnected and, frankly, fragile the tech ecosystem has become. The entire innovation pipeline is bottlenecked right now at the IPO window.
Which brings this right back to you, listening to this deep dive. Whether you actively trade individual stocks or not, this $180 billion market shift is directly impacting your financial reality.
Absolutely.
If you hold a standard index fund or a retirement account, those large-cap growth mandates we discussed mean your portfolio is likely shedding reliable, established tech stocks right now just to make room to absorb the sheer mass of these incoming IPOs.
It's unavoidable.
And beyond your portfolio, whether you rely on ChatGPT to draft emails or Perplexity to synthesize research, the future capabilities, the tools you use every single day are hanging in the balance. They are entirely dependent on whether Wall Street has the liquidity to fund this next phase of development.
And as we monitor these filings and, watch the institutional capital being repositioned, I won't leave you with one final thought to mull over. Building strictly on the market physics we've unpacked today.
Go for it.
We know that Silicon Valley is pushing these mega IPOs forward because they desperately need Wall Street's capital to fund trillions of dollars in physical data center infrastructure.
Right.
And we already know that the public markets are struggling under the reallocation pressure just to absorb the initial stock offerings.
Yeah, they're barely handling it.
So if these three mega IPOs manage to drain the public equity markets entirely dry just to pay for all that concrete, copper, and computing power, what happens if the broader societal appetite for AI tools cools down before those data centers are even finished being built?
Oh, wow.
Who is left holding the bag on the most expensive infrastructure project in human history?
Man, that is a massive multi-trillion-dollar question. And the answer will likely define the financial markets for the rest of the decade. We are definitely going to be tracking the mechanics of this very closely as 2026 unfolds. Thank you for joining us for this deep dive. Keep questioning the headlines, keep looking at the underlying physics of the market, and we will catch you next time.